Hello, my name is Sally. In this video, I will tell you about the stock portfolio model, TLX4 saving. The subject in this video 1 is about active investment strategy versus passive investment strategy. TLX4 is 95% passive. Before we get into details, let me first explain the difference between active and passive investment strategy. My colleague Jason will explain active investment strategy.
Hi, I am Jason. Let's get started. Active investment strategy. An active investment strategy requires that a human or machine executes portfolio management based on changes in the market due to financial events. As you can see in video, the active person tries to predict the market. When market go down, he will sell. When market goes up, he will buy. The objective of an active investment strategy is to beat the stock market's average returns by predicting corrections and take full advantage of short-term price fluctuations. This implies trading and analytical costs that depends on the frequency of trades and predictions. Joanna will explain about the passive investment strategy.
I hope you are still with us and did understand Jason's explanation. I will explain you the opposite strategy. Passive investment strategy. Warren Buffett is well known for this strategy. Buffett almost never sell. A passive investment strategy implements a long-term position in the stock market by limiting the amount of buying and selling while managing a portfolio, thus requiring a buy and hold strategy by the portfolio manager. This implies a more cost-effective strategy since trading and analytical costs is set to a minimum and shields against sudden reaction or anticipation of the stock market's movement. Usually, the passive investment strategy is used by index funds that follows one of the major and common indices like the SPX 500. The returns from index funds are based on the average return from the stocks in the selected index. Before Sally will explain about what we do in our portfolio stock model, let us take a look at some historical data first. SPX 500 is 500 companies from North America. The stock market start from about 15 and raised to more than 3,000 today. If you bought 10 stock in 1927, you would probably be rich today. You can see in video.com crisis on the first top here. The second top is the financial crisis. After that almost straight up. But in history we had a lot more crises. When we zoom in a period of 10 years at the time, the pictures look different. The Great Depression was very long, over a decade. (1947 to 1957) was easy years in only one direction. Up, up and more up. (1957 to 1967) had a little more volatility but still up and more up. (1967 to 1977) more complicated, with war and oil crisis. 1978 to 1987 again an easy decade. (1987 to 1997) looks easy, but in start of decade did we had Black Monday. 1997 to 2007 we got hit by the dot-com crisis. Many new technologies companies were just good ideas but could not turn it into sustainable and profitable business. A bubble was created. 2007 to today. We started again with another bubble. Result the financial crisis. Only very few decades has been neutral and only one negative. You might think, the active investment strategy is best. True if we know when market goes up and down. But according to the company Morningstar and Standard & Poor, does 89% of all funds perform less good with an active investment strategy? And over loan time close to zero. So in our strategy do we choose the safe approach? Let's get back to Sally.
TLX4 saving. Saving implements an approach to stock portfolio management that is similar to the passive investment strategy of an index fund, just with a few add-ons. The model behind TLX4 saving is based upon two assumptions. Stocks in the American SPX 500 index rise over time. It means 20 years or more. Remember here what Joanna just showed us. The second assumption is, if the world goes into recession, the price of gold will rise. In the Great Depression, did gold go up with 69%? At the financial crisis in 2008, did gold go up with? Those videos introduces the model behind TLX4. What is the approach, why do we think that it works, and what do we do to safeguard our investments? Thank you for watching. I hoped you learned something and is ready to learn more about TLX4. Have a nice day and goodbye.